Not because things improved, but because something got lighter. Look at this setup. Revenue is up, profit is up, and at the same time, provisions are down. That combination looks strong. But here's the question that stays. Did the business actually get better, or did the risk just move forward in time? Look at the numbers. Revenue goes from $45.3 billion dollars to $45.8 billion dollars to $49.8 billion. Dollars. That's plus 8.8% in one quarter. Now pause there. That's not slow growth, that's a jump. A bank doesn't grow like this in many ways. It's either lending more, charging more, or activity in markets is picking up. And when growth comes this fast, the question changes. Is this something that repeats or something that happened at the right moment? Now break the machine. Out of $49.8 billion, $23.4 billion comes from CIB. That's almost 47% of total revenue, nearly half, not from consumers, not from everyday banking, from markets, trading, deals. That kind of revenue moves differently. It can rise fast, like this quarter, but it can also pull back just as fast. So now the question shifts. If almost half the engine depends on markets, what happens when activity slows down? Look inside that segment. Markets grew plus 33.2% quarter over quarter. Banking grew plus 8.0% quarter over quarter. That's a big gap. Growth is not balanced, it's concentrated. Think of it like this: one part of the business is steady, the other is accelerating hard, and the faster side is markets. So here's the tension. If this growth is coming from trading activity, is that something you can count on next quarter? Now look at profit. From $13.0 billion dollars to $16.5 billion. Dollars. That's plus 26.6% in one quarter. That doesn't happen without something moving underneath. Profit always comes from three things: revenue, cost, and credit. So the question is not profit went up, it's which of these three moved the most to push it this high? Here's where it gets uncomfortable. Revenue grew plus 8.8%. Costs grew plus 12.0%. Costs are moving faster than revenue. Now think about a simple business. You're selling more, but your expenses are rising even faster. You look bigger, but you're not getting lighter. Now look at the ratio: 53.9% cost to income. Almost 54 cents of every dollar goes to cost. And before, it was 52.4% and 52.1%. So it's rising. The bank says it's investing. Fair. But here's the pressure point. If revenue slows, does this cost structure adjust or does it stay? Now look closely. Provision drops from $4.7 billion dollars to $2.5 billion. Dollars. That's minus 46% in one quarter. That's not small. Translate that into real life. It's like the bank saying, "We believe fewer people won't pay us back." And that difference, more than $2 billion, dollars, flows straight into profit. That's a big part of the jump we saw. But here's the tension. Did the risk actually go down, or did the expectation change? Because this number doesn't remove risk, it just changes when you recognize it. Now combine it. Net margin is 33.1%. That means one third of revenue becomes profit. Strong. But at the same time, cost ratio is 53.9% and rising. So you get a contradiction: more profit, but less efficiency. Think about that. If the business were improving structurally, would both move in opposite directions? So what's holding margins up? Better operation or something temporary helping the result? Look at returns. ROE goes from 15% to 19%. ROTCE from 18% to 23%. That's a sharp move. It means the bank is generating more profit per dollar of capital. But connect this back. Profit went up while provision went down. So now ask, are returns improving because the engine got stronger or because less risk is being recognized right now? Put everything together. Revenue up plus 8.8%, provision down minus 46.1%, profit up plus 26.6%. That combination amplifies earnings. Growth on one side, lower credit cost on the other. It's powerful. But it also creates dependence, because now profit depends on both staying favorable. So the question becomes, what happens if one of these moves in the opposite direction? Step back and look at the full picture. Growth is being driven heavily by markets. Costs are rising faster than revenue. Provisions are dropping sharply. Returns are increasing. All of this is happening together. So there are two possible readings. One, the bank is executing well, scaling efficiently, and managing risk. Or two, part of this performance is coming from favorable conditions, market strong, credit light, that may not repeat. So here's what remains. If markets cool, if credit normalizes, if costs stay where they are, what part of this performance holds and what part fades?